Hello investors, welcome to Simpli Stocks. Looking at the market correction, today we will talk about 4 good companies that are doing very well from business point of view, but because of this correction, they are trading at good discounts from their highs. Our previous video was regarding small caps, but today we have brought discounted opportunities for you from micro caps space where valuations are currently very attractive. Our focus will be on understanding growth triggers and valuation. And yes, as a standard disclaimer, this video is not a buy or sell recommendation on these stocks. Please remember this. With this, let's begin. The first microcap business on our list is Tembo Global Industries. Until now, Tembo has been in the low margin textiles business, but now they are entering in the engineering products, defense and solar sectors. Because of this, growth is good in Tembo, but at the same time, its margins are also expanding due to the change in product portfolio. Therefore, the bottom line growth is even better. Last year, their 60% of sales came from textiles, and according to their guidance, this segment's contribution will come down to only 30% this year and just 10% next year. In their engineering products business, they manufacture clamps used for shipbuilding, industrial machinery, refineries, and other sectors. These clamps are used to hold pipes, machinery, etc. They have a manufacturing capacity of 18,000 metric tons for these engineering products, and they are entering these two product segments, ERW pipes and strut channels. ERW pipes are used in oil and gas, water and sewage management, and strut channels are used in construction, electrical and plumbing works. Overall, their total manufacturing capacity will increase directly from 18,000 metric tons to 105,000 metric tons. Apart from textiles and engineering products, Tembo is also in EPC services. In this, they do construction work for fuel farms and marine jetties. This is also part of their engineering solution segment. This year, Tembo's management had given a sales target of around 1100 crore, which translates into sales growth of about 48 to 50% from previous year. From April to September, they have clocked sales of almost 494 CR or 500 CR, which is roughly 45% of the guidance already. In my understanding, they will be able to complete their 50% sales growth target by the end of H2. Plus, the margin expansion is happening here as well. This year, their EBITDA margin has gone from 9% to 13.5%. So, at the business level, Tembo is doing very well. But on the other hand, you can see that it has corrected 30 to 35% since December 23rd and is currently trading at a PE of 13 to 14. There is already very good growth in the business. Furthermore, the engineering products capacity has not even come yet. When the new capacity will go live, then more growth and margin expansion will be visible. Besides, the company is progressing rapidly in the defense and solar businesses too. As we were shooting this video, Tembo got its defense license. Now, if I summarize through this screenshot, Tembo Global is currently in these two businesses, which are engineering solutions and textiles. And going forward, they will be entering solar and defense manufacturing as well. And here you can see that EBIT margin in textile segment is only 2.1%, while in engineering solutions, it is 17.6%. The next business we will cover is Thomas Scott. This company is also in the portfolios of Shankar Sharma and Ashish Kacholia. Shankar Sharma has 8.3% stake here and Ashish Kacholia has 2.1% stake. Although Thomas Scott is in the textiles business, but it is not an ordinary low margin contract manufacturer. They have their own brand by the name of Thomas Scott, which accounts for 45% of their sales. Also, Thomas has a very interesting division of licensed brands. They have partnered with Myntra, Ajio, etc., where they manufacture and sell clothes for their brands on a license basis. They manage everything from designing and raw material sourcing to manufacturing clothes, and then list and sell those clothes by themselves on these apps or platforms. They manage this entire end-to-end work. As you can see here, they manage top brands for Myntra on license basis like Marston Harbour, Invictus, Aeropostale, FC UK and Nautica. This licensed brand segment contributes to 60% of their sales. Now, if we look at it on a half-yearly basis, so far the company has achieved 1111 crore sales and 8 crore net profit in the first 6 months of the year. Although management does not give any guidance, but assuming the same performance for remaining 6 months, they can achieve sales of around 225 crore for the year. If we assume 7% net profit margin, then net profit can stay around 16 crore. As for the stock, in the last 1.5 months, it has corrected by around 35% and is currently at its P of 30. And although the valuation of Thomas Scott will seem a bit premium to you, but you should not look at it like other contract manufacturers in the textile sector. It is a good proxy business for e-commerce growth in India. So you can study it yourself once. Now a humble request, if you are liking this video so far, do give me a thumbs up. Also, you can subscribe to our channel Simpli Stocks, where we bring multiple such videos every week. Honestly, your likes and subscribes are our only motivation so that we keep bringing such high quality research to you for free. So do like this video and yes, also subscribe to our channel. Coming back to our discussion, the third microcap business that we will cover is Unihealth Hospitals. Unihealth runs a 120-bed hospital in Uganda, Africa. But main trigger is their emerging business in India. Their 52-bed hospital in Navi Mumbai started in October, and they are bringing another big hospital of 200 beds in Nashik, which will start in April or May this year. So in the next 5 to 6 months, their business is going to grow by 3 times, and these people will go directly from 120 beds capacity to 372 beds capacity. And then in the future, after Nashik, they also have a plan to set up a third hospital in India, in Pune, which will have a capacity of more than 125 beds. In the medium term, their goal is to bring 500 to 600 beds capacity in India. And then in the next 2 to 3 years, their goal will be to add more than 400 new beds in Africa. So in just 2 to 3 years, they have plans to exceed 1100, 1200 beds by expanding 10 times. Unihealth did rally after H1 results, but now after correcting by approx 25% from its peak, it is currently trading at a P of 18. So you are getting a 10x opportunity at a P of 18. The reason for good results in H1 was that they bought super specialty treatments like IVF and spine surgery in their Uganda business, which increased the ARPOB by 60% from 24,000 or 25,000 and reached 40,000. Basically, they have been able to charge more from their patients over there. And next year, they have guided to grow the ARPOB further from 40,000 to 55, 60,000, which translates into growth of 35 to 50% for the Uganda business alone. The growth will also be there from Navi Mumbai and Nashik hospitals, but along with that, good growth will also be seen in the Uganda business. So see, Unihealth is in focus because of their Uganda business that has done very well right now. But their India business, which is the main trigger here and forms the long-term story of Unihealth, that journey has just begun. Therefore, even though it has rallied, now it has cooled down a little bit, and after correction, you can have it a look here once yourself. The overall story is still intact and growth is immense. Now, fourth and last business that we will cover has corrected the most from its peak. The company's name is Cellecor Gadgets. It was trending last year due to the EMS theme, but as AC manufacturers and other EMS players went out of trend, it has also been underperforming since then. It has corrected 65% from its 52-week high and is currently trading at a very attractive PE of only 18. However, Cellecor is not an EMS player. It is a branded consumer electronics player. It is in the business of selling smartwatches, headphones, fridges, TVs, ACs, etc. And it mainly targets the middle class and lower middle class segments. Cellecor gets its products manufactured on a contract basis from players like Dixon, EPAC Durable and PG Electroplast, and then they sell these products through retail stores via their distributor network. You will find their products at small organized retailers in the city. Along with this, they have also done partnerships with regional players like Oshia, Pai and Sangeetha. They are also listed on e-commerce and quick commerce platforms like Amazon, Flipkart, Zepto and Blinkit. Apart from this, they have also opened 8 stores of their own. So overall, Cellecor is an emerging player in the branded electronics segment, which targets low to medium budget customers. Now you can see that this year was not good for electronics players due to heavy monsoons. And because of GST rate cuts, customers had delayed purchases. Yet, Cellecor's performance has been good. In H1, their sales grew by 51% compared to the last year. Margins have fallen a bit, but overall, Cellecor's performance has been good. So you can study this business yourself once. Now, if you like this video, then do give me a thumbs up. Along with that, you can also subscribe to our channel. All these are very special but hidden stocks among microcaps. Researching and studying these businesses takes a lot of hard work and a lot of time. So please do like this video, and yes, also subscribe. I'll see you in the next video. Happy investing.